Let me ask you something. What if the thing that finally breaks the global economy is not a war, not a stock market crash, not a sovereign debt default, but a tiny piece of hardware that most people have never even thought about? What if the trigger that sends the largest financial house of cards in human history tumbling down is a memory chip? That is not a hypothetical. That is a real possibility we are staring down right now. And today, we are going to connect the dots in a way that most financial commentators are either too cautious or too close to the action to do. Because what we are really talking about is not just a RAM shortage. We are talking about a convergence of pressure points, each one historically unprecedented on its own, all piling on top of each other at the same time. And the RAM crisis might just be the match sitting next to the biggest pile of dry kindling the global economy has ever produced. So let us start with the RAM crisis itself. Because if you have not been following this story, you need to understand just how strange and significant it is. Random access memory is the short-term working memory of virtually every computing device on the planet. Phones, laptops, gaming consoles, servers, televisions, medical devices, industrial controllers, all of it runs on RAM. And here's the kicker. Roughly 93% of all DRAM chips in the world are produced by exactly 3 companies: Samsung, SK Hynix, and Micron. 3. That is the entire foundation of the modern computing world sitting on a 3-legged stool. Now imagine that all 3 of those legs suddenly decide to pivot, because that is exactly what has happened. The artificial intelligence gold rush has created an insatiable demand for a specialized type of memory called high bandwidth memory, or HBM. AI training systems require enormous amounts of it. And since all memory types share the same wafer fabrication process, every wafer that gets allocated to building HBM for an AI data center is a wafer that does not become the RAM inside your next laptop, your phone, or your gaming console. It is a zero-sum game, and the AI industry is winning that game in a landslide. Reports have indicated that OpenAI alone secured an estimated 40% of global DRAM production for its infrastructure build-out. Read that again. One company, 40%? The rest of the tech industry, including Google, Microsoft, and every consumer electronics manufacturer on Earth, is fighting over what is left. Google reportedly tried to secure additional HBM allocations and was simply told there was nothing available. Executives were fired over it. Microsoft flew representatives to South Korea to negotiate directly with SK Hynix, and the talks broke down badly. Meanwhile, Micron, one of the big 3, announced it was stepping away from consumer RAM entirely to focus on the far more profitable enterprise and AI market. And just like that, a massive chunk of global consumer memory supply simply walked out the door. The downstream effects are already materializing in ways that hurt real people. Apple is reportedly paying a 230% premium for memory in its latest iPhone Pro models. PC makers are scrambling to secure supply that may not exist until 2027. Some manufacturers are considering shipping devices with less RAM just to keep production lines moving. The consumer electronics market could contract significantly in 2026 as a direct result of this. And this is all happening right now, not in some distant future scenario. But here is where the story gets much bigger and much more dangerous. The RAM crisis does not exist in isolation. It is landing on top of an economy that was already loaded with structural problems so severe that in any previous era, each one alone would have been considered a crisis. We are living through all of them simultaneously. So let us walk through the other pillars holding up this crash scenario, because the picture they paint together is unlike anything we have seen in modern economic history. Start with U.S. national debt. The United States has now surpassed $38.5 trillion in total federal debt. Let that number sink in. This is not just a big number, it is a structurally destabilizing one. The U.S. government is now spending more money servicing the interest on that debt than it spends on national defense, more than it spends on Medicare. The budget deficit is not shrinking, it is accelerating. And the political will to address it is essentially non-existent on either side of the aisle, because any serious attempt to cut spending or raise taxes enough to matter would be electoral suicide. So the debt grows. And as interest rates stay elevated or rise further, the cost of carrying that debt grows with it. Every percentage point increase in borrowing costs adds hundreds of billions of dollars in annual interest payments to a budget that is already hemorrhaging money. This is not sustainable arithmetic, and everyone in serious economic analysis knows it. Now add the energy crisis. The conflict involving Iran has created significant instability in global energy markets. When energy prices spike, the effects ripple through every sector of the economy simultaneously. Manufacturing costs go up, transportation costs go up, household energy bills go up. And here is the particularly savage irony for our story. AI data centers are among the most energy-intensive facilities ever built. We are talking about structures consuming gigawatts of power. Meta reportedly has plans for a data center so large it would cover a substantial portion of Manhattan. These facilities require not just electricity, but enormous amounts of cooling water as well. So, at the exact moment when energy is becoming more expensive and less reliable due to geopolitical instability, the AI industry is placing unprecedented demands on the power grid. The costs of running these data centers are going up, the costs of building new ones are going up, and the supply chains required to construct them are already strained. This feeds back directly into the AI bubble story, which we will return to in a moment. Then there is the weakness of the US dollar. A weakening dollar creates a complex and dangerous feedback loop. It makes US debt less attractive to foreign buyers, which pushes yields higher, which increases borrowing costs, which accelerates the debt spiral we just described. It raises the cost of imports, contributing to inflation, which constrains consumer spending, and it signals to global markets that confidence in the American economy is eroding. When the world's reserve currency looks shaky, risk appetite across global markets contracts. Capital flows become erratic. Emerging markets that hold dollar-denominated debt get squeezed. The whole system becomes more brittle. But perhaps the most underappreciated structural problem in this entire picture is the extraordinary bind that the Federal Reserve and the US government now find themselves in. For years, following the 2008 financial crisis, the policy of choice was monetary easing. Interest rates were kept near zero. Money was printed, asset prices were inflated, and that era of historically loose monetary policy has left the financial system deeply addicted to cheap money. The challenge now is that the Fed has very limited room to maneuver. If they cut rates aggressively to stimulate the economy, they risk reigniting inflation and further weakening the dollar. If they raise rates or keep them high to fight inflation and defend the dollar, they accelerate the debt crisis and risk tipping the economy into a recession. There is no clean path. The conventional tools that central banks have used to stabilize economies in past downturns have been largely spent. The ammunition locker is mostly empty, and that means that if a significant shock hits, the policy response available will be far weaker than what was deployed in 2008 or during the pandemic shock of 2020. Now layer on the commercial real estate crisis. Office vacancy rates in major American cities have hit levels not seen in decades, and in some markets not ever seen. The work-from-home shift permanently altered demand patterns for commercial office space. Billions of dollars in commercial real estate loans are coming due at a moment when property values have declined, and refinancing at higher interest rates is simply not viable for many property owners. Regional banks are heavily exposed to these loans. The potential for a cascade of commercial real estate defaults creating a regional banking crisis is real and ongoing. This is not an abstract risk. It is a slow-motion process already underway, adding systemic pressure to a financial system that cannot afford more of it. And sitting underneath all of this is the geopolitical instability that has made coordinated global economic management nearly impossible. The conflict in Iran, ongoing tensions between major powers, trade fragmentation, supply chain nationalism. The era of reliable multilateral cooperation that helped stabilize economies after previous shocks is effectively over. When the next major economic disruption hits, the international institutions and alliances that previously helped contain the damage will be far less effective. Countries are increasingly looking inward. The globalization that helped create decades of growth and relative price stability is unwinding, and there is no replacement mechanism ready to fill that void. So we have a debt bomb, an energy crisis, a weakening reserve currency, a central bank with almost no usable tools left, a commercial real estate time bomb ticking inside regional banks, and a geopolitical environment where international coordination has essentially collapsed. Each one of these is serious. Together they form something that genuinely has no historical parallel in terms of simultaneous scale and interconnection. And now we return to the AI bubble, because the artificial intelligence investment boom is not just an economic phenomenon. It is the story that ties most of these threads together. Trillions of dollars are flowing into AI infrastructure based on the expectation that the returns will be transformative and rapid. Data centers are being built at a pace that strains energy grids and supply chains. Chip manufacturers are restructuring global production around AI demand. Financial markets are pricing AI stocks at valuations that assume nothing short of a complete reinvention of the global economy. But the honest questions are starting to get asked in places that matter. Even those at the absolute center of the AI boom have acknowledged publicly that the current excitement may have outpaced reality, that investors may be getting ahead of themselves, that some people will likely lose a lot of money. The history of transformative technology bubbles is instructive here. The internet was genuinely transformative. It genuinely changed everything, and the dot-com crash still wiped out trillions in market value and sent the economy into a prolonged downturn. The technology being real and important does not prevent the bubble from bursting. It just means that the technology survives the crash, while the investors who overpaid and the companies that overleveraged do not. The RAM crisis is accelerating the timeline of a potential AI bubble correction in ways that are not fully appreciated yet. Here is the mechanism. As memory costs surge, the actual cost of building and operating AI infrastructure increases dramatically. The financial models that justified those trillion-dollar investment projections were built on assumptions about input costs that are now significantly wrong. At the same time, if consumer electronics markets contract because devices with adequate RAM become too expensive to manufacture or purchase, the addressable market for AI-powered consumer products shrinks. The revenue projections that justify current AI valuations depend on mass market adoption. A RAM shortage that makes smartphones and laptops more expensive and less capable directly undermines that story, and perhaps most critically, if memory constraints slow down the pace of AI advancement. By limiting training capacity and deployment scale, the timeline for AI to deliver the returns investors are pricing in gets pushed further out. That alone is enough to shake confidence in valuations that depend on near-term transformative impact. Memory chip executives are not speaking in hypotheticals anymore. They are openly describing a situation where major technology companies cannot be supplied with what they need and face the prospect of not being able to operate their businesses without it. Japanese retailers are reportedly limiting how many hard drives individual consumers can purchase. Major PC manufacturers are announcing price increases, and in some cases may revert to shipping devices with configuration specs that would have been considered inadequate years ago. Analysts at major research firms are projecting meaningful declines in PC and smartphone markets, specifically tied to memory supply constraints. The CEO of a major RAM design company has warned that consumer electronics manufacturers could face bankruptcies or be forced to exit product lines entirely by the end of 2026. This is not a normal supply chain hiccup. This is a structural realignment of one of the most critical input supply chains in the global technology sector, happening at a moment when that supply chain was already under maximum pressure. And because building new memory fabrication capacity takes years and costs billions with uncertain returns. In a potentially post-bubble landscape, the relief is not coming quickly. Even if China's domestic memory production accelerates, most analysts believe meaningful additional supply from that direction is still years away and will not arrive in time to prevent the near-term market disruption. So let us return to the central question. Could the RAM crisis become the trigger that starts the avalanche? Or is it just one more pressure point adding weight to a structure that is already holding more stress than any structure in financial history ever has? The honest answer is that we do not know yet. But we can say this with confidence. The conditions for a significant global economic reset are better established today than at any previous point. In living memory, the debt is at historic levels. The energy situation is inflamed by active geopolitical conflict. The dollar is under structural pressure. The central banks have spent most of their conventional tools. Commercial real estate is quietly deteriorating inside the balance sheets of vulnerable banks. International cooperation is fractured. The AI bubble is sitting on increasingly questionable financial foundations. And now the single most critical hardware component that the entire AI investment thesis depends on is in short supply, getting more expensive by the month, and that shortage may not meaningfully resolve for years. Every historical economic crisis has had a trigger, a moment when the accumulated pressure found a release point and the system snapped. Sometimes the trigger looked obvious in retrospect. Sometimes it looked almost absurdly small, relative to the scale of what it unleashed. The subprime mortgage market, relative to the global financial system, was a small thing, but it was the right small thing in the right fragile moment. The question we have to sit with right now is whether the RAM crisis is that kind of trigger, whether the memory shortage that is already disrupting consumer electronics markets, accelerating AI infrastructure costs, and beginning to challenge the financial assumptions underlying the AI investment boom, is the event that crystallizes doubt across the entire over-leveraged, overhyped, structurally fragile system we have built. The snowball is already at the top of a very steep hill. It has been growing for years, and right now it is sitting on a surface that is more unstable than it has ever been. Whether RAM is the push that sends it rolling or whether it takes something else entirely, the trajectory of where we are heading feels clearer than at any point in recent memory. The smart move is not to panic. The smart move is to understand what is actually happening, to connect the dots that most people are deliberately keeping separate, and to make decisions with clear eyes about the world that these converging pressures are building toward, because the question is no longer if something breaks. The question is when, how big, and whether anyone will be genuinely prepared for what comes next. Stay informed, stay skeptical, and keep watching, because this story is only getting started. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.